A very good morning. There is a thing that smart desks do that almost nobody talks about. They tell you their conviction not by what they buy, by what they trim. Yesterday, on a green day, when Nifty was up by 0.81%, two of the biggest desks on the chain quietly took their hedges off. Pro cut 33,000 long puts, FIS cut 56,000 long puts, both on the way up, both at an IV of 15.89%. That is not bleed at that wall level, that is conviction. Then the market opened today and it gives us the magnet at which the bell is going to ring. Gift Nifty minus 93, right now trading at 24,000, which is exactly the chain wanted it to be. This is the Tanmay Edge, episode 28, monthly plus weekly Nifty expiry stacked on the same day, the biggest gamma collision of the cycle. Let me walk you through what changed overnight and what did not, and what I am actually doing about it. Let's rewind 72 hours. Friday closed at 23,898. Brent was at 107. USD INR was at 94.25. Crude was hot. Currency was breaking. And the gate, which is the macro tell I have been tracking, was live both legs going into Monday opening. And yesterday, the tape did something I did not expect. It ignored the macro stress and rallied up 195 points. Wall crushed 6.84% on a green day. VIX closed at 18.37. Writers won the day for the fifth straight session. By the close, Nifty sat at 24,092 and the chain reorganized in front of us. The new map looked like this. 24,000 became the mega magnet. 19.4 million option lines stacked at one strike. PCR 2.2, the floor walked up to 24,050 with 4.28 million fresh puts OI added in one session. The old wall that you remember at 24,200 got trimmed by 4,80,000 contracts, and a brand new ceiling appeared at 24,300 with 1.91 million fresh call OI added in the same session. That is not normal. Walls do not just sit there at expiry, they migrate. Yesterday they migrated up. Hedges off, ceiling up, wall crushed. The setup looked like a clean pin for Tuesday opening. Then overnight something different happened. Yesterday Brent did not cool, it went the other way. From 107.45 yesterday evening to 109.38 by 8 am this morning. Almost $2 added in 14 hours. The Brent leg and gate is widening, not narrowing into expiry. USD INR held at 94.20, did not break 94.50, so the forex leg is flat, but European yields ticked up overnight. France 10-year up 1.18, Germany's 10-year up 0.97, UK 10-year up 0.85%. The bond market is repricing inflation while crude refuses to settle. US held their records. S&P 7173, Nasdaq 24,887, Dow futures up 60 points. Nothing's wrong there. But Asia has rolled. Nikkei minus 0.51% of yesterday's record. Hang Seng minus 0.63%. Jakarta minus 0.63%. Only Kospi 0.89% and Taiwan up 0.4% stayed the bid. So Gift Nifty opens minus 93 right at 24,000. The magnet itself at the bell. Now ask yourself this, if you are the desk that pulled hedges yesterday at an IV of 15.89, what does that gap down feel like when you wake up and see Brent at $109? Here is the part I want you to sit with me. A gap down that lands exactly at the magnet does not make the pin easier, it makes it harder, and this is mechanical, not subjective. In a normal pin day, spot trades sideways, theta bleeds, the straddle wall crushes further, premium goes to 0 by 3:30. The chain pulls spot to the strike where call writers and put writers are stacked together. That strike today is 24,000. The market just delivered that level at the open. The pin is not the target anymore. It is a question. If 24,000 holds as floor, we are still inside the pin scenario. Spot drifts 24,000 to 24,150 all day. The straddle at 187 prints. Branch A, that is the base case. If 24,000 breaks, that is when the magnet flips function from support to launchpad. Spot punches through 23,950 fast and opens the path to 23,820, which is the one standard deviation lower band on a 213 straddle. That is branch C. I will not pretend branch C is a tail today with Brent at 109 with Asia red with the gap at the magnet on a day 1, I think Brent C is materially in play. Maybe 1 in 4, maybe 1 in 3 chances, higher than I would have called it yesterday evening. The pros desks that pulled yesterday were betting 24,000 holds. The macro this morning is testing that bet inside the first 5 minutes. One quick note before I land the trade, because this comes up every time I post FIS numbers. FIs have added 1900 fresh shots on a green day yesterday. Light ad. Headline says they are bear. Headline is completely wrong. FI index short futures book is 2 lakh contracts. FI stock futures long book is 9 lakh contracts. Ratio is 4.37:1. That ratio grew from 4.26 from yesterday to 4.37. That is not a directional bet. This is a portfolio hedge against a long stock book that grew bigger on Monday than it was on Friday. FI is not calling a crash. They are ensuring a long. Read it in that way every time you see those headlines. And here's is where I land. And I'm going to be straight with you today. I am less certain today that I was yesterday evening. My base view is buy on dips with hedge, same as last episode, but the condition changed and I want you to walk through both sides. Buy on dips because the structural setup that got us here is intact. Hedges removed at 15.89, pro long doubled to 24,000 contracts Monday, plus 22,000 fresh long calls added. FI pair trade growing on the long stock side, plus 31,000 fresh stock long contracts added yesterday. None of that unwinds in one gap down. The institutional structure is still constructive on 1 to 2 week view. With hedge, because Brent at 109.38 is not a noise and the gate has been live 6 sessions now. Yesterday the tape ignored it. Today it might not. If 24,000 breaks at open, 23,950 breaches extremely fast and the trade is upside down with a put underneath. Where I might be wrong today specifically, and if Asia stays soft through the open, if Brent prints 110 plus intraday, if USD INR breaks 94.50 by lunch, any of those and the Brent C goes from possible to probable. That is 23,800 is possible. So my plan, buy 24,000 level if the gap holds and we quickly reclaim about 24.50 in the first 3 minutes. Hedge it with 23,900. The put is still cheap given at 15.89 IV and just 6.5 hours left for the expiry. If 24,000 breaks in the first 30 minutes and does not reclaim by 10 am, I am not buying. I am sitting in the hedge and waiting for 23,950 to test as the support before doing anything. Cap is 24,300 now, not 24,200. The wall has just walked up. Trim there if we get there. For straddle sellers, same level, 24,000 to 24,150 if the gap reclaims. Skip the trade if it does not. Premium rebuilds fast on a break and the pin can blow before noon on a max gamma day. The thing about a monthly plus weekly expiry on the same day is that the chain decides faster than you can read the news. 30 million lines of OI all settle in 6.5 hours. You do not need to be right about direction today. You need to be right about one level. 24,000. Watch what it does in the first 30 minutes. The rest of the day reads itself. The trader who wins consistently are not smarter, they are just earlier. You have gotten earlier here. This was the Tanmay Edge episode 28. You can stream it live on rupeecase.com, free on Apple Podcast, Spotify. See you all tomorrow, guys. Have a happy expiry.